New Year.
Thank you.
At this time of year, it's always interesting to look back on last year and sort of look at some of the events. And one in our industry that stands out for me is really sad, and that is Warren Buffett's partner, Charlie Munger, died. And Charlie was a colorful guy, right? And one of my favorite quotes from him, he was asked one time, he said, somebody asked him, Charlie, what's your secret to successful investing? He said, investing is simple. Find 3 or 4 companies that you like, and then sit on your ass for a long time. I don't think that's the kind of advice your clients are looking for. Am I right about that?
Yeah.
So I prefer to sort of go back to last year, and one of the analysts that I follow is a guy by the name of Jason Valancourt. And in his third quarter outlook last year, he said the same thing Charlie Munger said. He said, investing is simple, but he said it's not easy. So there's 3 things you need to do. 1, you need to be right a little more often than you're wrong. 2, you need to structure a portfolio in such a way that the magnitude of your gains more often than not exceeds the magnitude of your losses. And 3, you need to relentlessly pursue diversification wherever you can find it. In doing that, by finding assets that aren't correlated, you reduce volatility and therefore increase the likelihood of investor success. Let me repeat that just to make it really clear, because that's really what our focus is going to be in this meeting today. If you blend low correlated assets, you reduce volatility and therefore increase the likelihood of investment and investor success. Does that make sense to everybody? Yes. All right. Given that, Misty, I'm going to pick on you, and you and I are going to. I'm not picking on you, actually. I'm actually going to bring you an opportunity. Right? You've got a great practice. I've always admired you and your team, and I'm a new client. I was just referred to you.
Okay.
I was referred by a mutual friend of ours, and I'm just retired, and I'm bringing you my $3 million rollover.
Okay.
I've met with you and your team. We've come to the agreement, the investment agreement, that my $3 million, I don't really care. I don't need it to go to $6 million. I just can't afford to have it go to $2 million. With that as a background, and don't get overly complex in this, how would you see you and your team allocating that portfolio between stocks, bonds, and so forth?
Probably a majority of it would be in stocks, but then I would also have a good allocation to a bond allocation. I'd probably do like a 60-40.
Oh, so all right, let's work with 60-40 then, okay? And if we looked at a 60-40 portfolio, if we looked at the 60%, I mean, I'm assuming you would view that as sort of the growth portion of the portfolio. That's where you're going to drive your return going forward. Is the bond portion of the portfolio designed to, you want to get a little bit of return, but is that there to provide some defense, a buffer to the portfolio, if you will?
Absolutely.
You know what? It's been a great portfolio. Throughout most of our careers from 2000 to 2020, over that 20-year time frame, which if you look at it was for the most part a declining interest rate environment with low inflation, stocks and bonds weren't correlated. And that 60-40 portfolio, they didn't go the same direction at the same time, and that allowed us to answer that client's question every time they called you as an advisor. And that question was always this: as stocks reached new highs, Misty, why do I own these bonds? They stink. But it gave us the opportunity. It gave us an answer, right? And the answer very simply was, well, Mildred, the reason you own bonds is because when stock prices go down, bond prices do what?
Go up.
That's right, and it worked perfectly for 20 years. In 2020, things changed. Mm-hmm. COVID hit, right?
Right.
Economy stopped. Mm-hmm. Government decided we've got to spend money, and they spent a boatload of it. That inevitably drove inflation, and that brought the Fed in to begin raising rates. Mm-hmm. And the relationship between stocks and bonds changed. Mm-hmm. They became correlated. Now that's not historically unusual.
Correct.
If you look back over history, anytime inflation's more than 4%, 100% of the time stocks and bonds get correlated. Mm-hmm. And if you have inflation running between 2 and 4%, it's a majority of the time. It's 65% of the time they're correlated. And that correlation hurt in 2022. We all experienced it, right?
Oh, absolutely.
You woke up at the end of the year and your equity portfolio was down north of 20%. and you look to your fixed income portfolio to provide that balance, that ballast, and what do we look at? We looked at double-digit negative returns. Now, the good news is rebounded in 2023. Stocks and bonds, floated around break even for most of the year. Then we had a hockey stick move at the end of the year, and they both ended up, but they both ended up correlated. So Misty, let me ask you a question, and I don't mean to put you on the spot with this.
Sure.
But that new client that came in with $3 million and you put in a 60-40 portfolio, you did a great job of diversifying the equities across large cap, small cap, international, domestic, did the same thing on the fixed income side of the equation. Are you comfortable having all those asset sleeves move the same direction at the same time?
Actually, Paul, I'm not, and Mildred's not happy.
And I wouldn't be comfortable if I were you, and if I were Mildred, I wouldn't be comfortable if I was her. And so that's a problem that we see at Locor we're currently faced with today. So what do we see as the solution? What we see as the solution is take a look at the institutional marketplace. Institutions, and by that I mean the foundations, the pensions, the university endowments. A good buddy of mine calls them high net worth individuals or two-legged institutions. You got those folks.
Those are good buddies.
For decades, for years if not decades, have been adding what they call alternative investments, what we call low correlated strategies. They've been adding those to their portfolios.
Okay.
And that bucket can in some cases be more than 50% of their portfolios. And why are institutions allocating money to alternative investments, to low correlating strategies? A, they want something that's not correlated to their stock and bond portfolio. And B, they want a return stream that gives them a better opportunity of hitting their mandates, of earning, of doing what they need to do to provide for the goals and objectives that they're trying to reach. At Locor, and by the way, if you haven't figured it out, Locor stands for low correlation. At Locor funds, we offer individual investors access to the same institutional strategies and institutional managers that we just talked about, and therefore getting Mildred, if you will, getting Mildred the same benefits that those institutions are getting in her portfolio, getting her something that's not correlated to the stock and bond markets. And the way we do that is via mutual funds. 40 Act funds, they're liquid daily, they're priced daily, and we have 5 of them. And I'll go over those real quickly with you. Here they are right here. I've given you all one of these sheets, and if you look at these 3 on the left, they're all different, but they all have the same objective. And the objective is to offer low correlation to both stocks and bonds. And if you look down here at the correlation to stocks and bonds, mission accomplished. And what I will tell you is the reason that low correlation is valuable in Mildred's portfolio is in 2022, when stocks were down double digits, bonds were down double digits, all 3 of these strategies were up. In fact, our core strategy, our macro strategies fund, was up over 15%. That's getting the job done. You're a sports fan. I know you're a sports fan.
Absolutely.
Are you a basketball fan at all? All right, but you're not like but you know the sport.
Absolutely.
If you were the head coach of a basketball team and you had 2 point guards and they both averaged the same number of points per game,
Okay.
but one of them played tenacious defense and the other was lazy, which one would you start?
I bet the person's going to be defensive.
Exactly. We're going to get to why that's so important here in a second, because I want to talk to you about this 4th fund. The 4th fund we call our Dynamic Opportunity Fund. It's a small cap fund, it's an equity fund, and it is benchmarked to the Russell 2000 small cap benchmark. Russell 2000 small cap benchmark. It's given over the years Russell 2000 small cap bench performance with half the standard deviation. Let me phrase that another way. Small cap performance with half the volatility. Small cap performance with half the risk. You wanted that point guard that plays defense? Here's an opportunity to get small cap performance without lighting your hair on fire.
Okay.
5th fund, that's our income fund. That fund's designed to provide low correlation to fixed income. The reason I didn't call it a fixed income fund is because it doesn't own any bonds. And if you look down here at the bottom and look at its correlation to bonds, it's negative. And yet the fund pays 9%. I'd be happy to talk with any of you about any of these strategies after the meeting one-on-one. But at the end of the day, as we say at LoCorp, markets have changed, institutions have figured it out, and we are now offering access to that kind of investment through our 5 funds. So what we think going forward is a 60-40 portfolio is dead. You need to be looking at a 60-20-20 portfolio. Yes, get the 60% in your stock, so you get the growth, 20% in fixed income, 20% in that low correlating asset sleeve. Let me know what I need to do to earn my piece of or all of that 20% of your portfolio. I'll be happy.